I'm going to go quickly through the usual monthly things because I have a lot more to go into based on the letter that we sent out last Friday, and wanted to go into depth on a few of the items there. Big picture, long-term trend is down. We're still below there. We had a little bit of a recovery. It looked like, as we mentioned, looked like a bear rally or a bear trap. I'll go into that a little bit more in the future, but generally the big picture is down. It's trying to recover, but today is not looking great either. And that's kind of the belief going forward, how things are going to progress, unless a lot of money comes back in this market and versus that. But Will's going to go into, and his portion, go into some reasons why that may not be the case either. A midterm cycle, again, is negative since the first of the month. It had a pretty good, a bit of a run, but again, it was a bear market rally, not necessarily a new bull market shaping up. So that ended, and then now we're back down in here. Sectors were +6 to -5. We were actually at 100% positive about 2 weeks ago, and it lasted a couple of days, and that was about it. And now we're very slowly pushing back more towards negative sectors. Interestingly, the negative sectors that are holding up are all the defensives, the real estate, the consumer staples, utilities, and healthcare. All the growth stocks are over here. You got the technology, financials, communications, and that's like the Facebooks and Googles, as well as consumer discretionary. So discretionary money is not going up either. Interesting that the energy and basic materials, who have been doing very well this year, they are starting to show signs of problems. I'm not sure how strong they're going to stay going forward, but that's what we're looking at right now. Okay, so what are we thinking about and doing right now? This is, again, going back to our letter of last Friday. And last month, we all got together at Shadowridge. We had a retreat, and we discussed these kind of situations and instances, and what are the best ways that we can deal with a coming recession and difficult markets, and what different tactics worked in the past, and what can we use going forward. So I'm going to go into where we kind of settled, we think is the strong way to proceed, but I'm going to give you a couple of other things as well. Oh, and certainly note that all the following examples that I show are for educational purposes, and they are not recommendations. So let's start with the possibility of a bear market starting. Typically, the yield curve is the 2 and the 10-year treasury if they flatten, and we'll probably spend more time on this, but typically that precedes a recession. The gray lines here are recessions. Down here, we get in 2006-07, we had a inversion, then a recession. Inversion, recession, very quick recession. Again, we did get an inversion about 2 weeks ago. This doesn't look like it did, but it did, and that's where we're headed. So this picture is a good, I think it was 10 out of 11 of the last recessions were preceded with this sort of setup, and we have it again. So we're certainly paying attention to that, and it's worth paying attention to going forward. And then secondly, I want to show you what a bear trap looks like, right? So the market is falling, and then it goes up. And really when it gets about right here, you start going, oh, well, we should just be fully invested. It's great. This bear market's over. And then, nope, there's the trap. And then, oh, no, things are good again. Oh, nope, there is the trap. And then it kind of continues, and the full bear market happened. If you go and look at 2008, which I don't have a chart for, it happens again and again and again and again, just repeatedly. And that's a difficult time to be invested, or trying to find, this is the bottom now, this is the bottom. It usually doesn't work out until something major shift happens. To revisit, what I'm going to go through is show you the last 3 big bear markets and how to look at them and how they played out, and then how we could use a market neutral strategy or a hedge strategy in those times, and see how it would play out and look compared to the markets. As I showed last month, this is actually the junk bond index. And when it's below this line, and this is very similar to our long-term trend that I showed in the beginning, that's showing negative and has been for a while. It did for this period, for 2020, the COVID crash. This was 2018. Federal Reserve was going to raise interest rates. Again, they did the same thing here, raise interest rates. And this was a 6-month grind down, really more sideways in the S&P, but the bond market had a rough time. The junk bond market did. We're going to look at all 3 of those situations and how to apply a market neutral strategy and see how it would have played out. So here's the COVID crash. Boom, very, very dramatic. One quick little bear trap there before it continued, maybe even another one there. And then it was okay, and things got better. For context, you can see how deep of a curve that is, because right here, this does not look as frightening as the previous slide, but it is the same picture. So really, for the month of March 2020, during the COVID crash, this was the worst of it. I took the month period of time, and the S&P was down about 12, NASDAQ in the green was down 7, yellow is the small cap Russell 2000 down 21. Now, actually, at these bottom points, all 3 were much, much worse than these numbers, right? So keep that in mind. And then looking at these, we could say, okay, well, the green, the Nasdaq is actually the strongest index. It actually would have made sense to have this ratio. So we could say, okay, well, let's be long the Nasdaq. It's the strongest according to relative strength and what the charts look like. And then the weakest would be the Russell 2000. That would be the small cap. So if we were to buy 50% of the Nasdaq and then short 50% of the small cap, we would get an equity curve that looks like that, right? And that would have a positive number of that period versus a negative. And there's still volatility there, but it's a much different ride than you're experiencing in a full bear market. So in the 2018, same situation. It was really a 3-month bear market. It was almost October 1 to December 31st. Really, Christmas was the bottom, but before it really turned around and started improving, you really kind of say it was the first of the year. So it was a really clean 3-month example of the same concept. Again, from that October 1 to December 31st, S&P red was down 13.5, green the Nasdaq was down 16, yellow the Russell 2000 was down 20. Again, the Russell was the weakest. The small cap was the weakest. Interestingly, though, the 13 was not the worst. It was actually down 20, and these other ones were down quite a bit more than that. Looking at this, red is the strongest. So this time the S&P is the strongest, shorting the Russell. So long the S&P and equal weight short the Russell would be the theory of how to play this. And in that situation, you'd end up with, again, a positive number. A little volatile there, but certainly not volatile like that volatile. So that's what we're looking at. And then for the third example, we're looking at this double dip we had in 2015. And again, this was again around the Federal Reserve raising interest rates. They had this thing, we had a bear trap, actually a couple little ones in there. And then we run up, and then nope, and then bear trap, and then no. And then things did finally get better around March of 2016. In that same example, we're looking at July of 2015 to February of 2016. That's a good amount of time to be just a messy market. And again, these don't show that drawdowns that we had, but for this whole period of time, the red again is the S&P. It was down about 4. NASDAQ was down about 2.8, say 3, similar, but very different rides. And then again, the Russell again was the weakest on the bottom by 16, by quite a bit. So again, interesting on this example is when we looked at it, really you could have gone NASDAQ or S&P for the long side, and then again, shorting the Russell 2000 in yellow for the side. So I went with the S&P. It was a little bit less volatile. In practice, it probably would have gone back and forth between the two, maybe a few weeks in the Russell, a few weeks in the S&P, a few weeks in the NASDAQ. It might have gone back and forth a couple of times as the green got stronger and then it got weaker. So that may have played out differently, but I thought a conservative in between was just using the S&P for the whole time. And that came out to that. Still positive number versus ugly negative numbers. And that's kind of what we're going for with market neutral. This is the kind of strategy when we're looking at these periods of time. Definitely a bear market. We're certainly in one now, and it would make sense to us to look at using this sort of concept inside of strategies. And we are actually using it in a few of them already, just for example. So if you have the advanced protect strategy, about 20% is short already in there against a 20% long. So a piece of it, not all of it, is running that strategy. The same goes for advanced maximize. I did start a separate one altogether that's called market neutral that just runs this strategy all on its own. So if you want to have just a little bit of it in addition or instead of something else, it's certainly something we can modularly put into a model. And then finally, Will's Future Tech is largely doing a similar concept as well. He has his own metrics for how it's done, but it really comes to a very similar result. And that's where we're at. And that's how we're dealing with this and how we're going forward with market neutral in our strategy. So I hope that's insightful. And let's go on to Will. Next up, Will, our VP of Research, author of the book, Why Bad Things Happen to Good Investments, is going to talk about recessions and go into the details that I did not go into. So hope that helps. See you next time.